Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk to you. It's been an interesting 3 months so far this year, that's for sure.
You said there was an interesting study about what kind of money is being taken in and out of the markets. What did the study tell us?
Well, at the beginning of every single month, Ameritrade releases something they call the Ameritrade Index, which gives you a rough idea of what people are doing that hold Ameritrade accounts. It's tens of millions of people. And then some other brokers have similar data. Merrill Lynch does this. Bank of America does this. And there's an article on CNBC that just came out today about their data. And when we pierce it all together, it shows that inside the United States, so far this year, American investors have been net sellers of individual stocks. That doesn't mean stock funds, just individual stocks. And Ameritrade reported that among their account holders, more people have been selling Facebook than buying it. I have a Robinhood account which shows you the top 100 most popular owned stocks, and Apple was number one almost all of last year, and it slipped down the list and been replaced, interestingly enough, by marijuana stocks. Now, however, the data that Merrill Lynch and Bank of America are sharing also show that American investors have been buyers, putting money into exchange-traded funds. In fact, last week they saw a net inflow of 854 million last week, higher than the 168 million the previous week. So people are piling in to exchange-traded funds while apparently getting out of individual stocks. And I think there's a very important reason for this, and that is that the most popular stocks, most widely owned stocks that people were buying over the past 2 years all led the stock market to the downside last year. We're talking, of course, about the FANGs, the Facebooks, the Amazons, Netflix, and Google. All these stocks, like badly, NVIDIA you can add to the list, and some of those stocks have barely even rallied with the stock market, badly underperforming. So what American investors have experienced was a horrible punch to the stomach last year, and then they've seen the stock market rebound, but these stocks that they own have not gone up as much with the market. And this really should have been expected, because when people are just all owning this thing, FANG, and it's taking up so much of the stock market, and you reach a turning point like we did last year, that's typically what happens. The previous winners of the bull market end up to be horrible laggards. There was the Nifty 50 in the 1970s that happened to, and then in the 2000 top, stocks such as Cisco and Oracle, everyone had to own them, and then they lagged the market for over 10 years. And I believe that's really what's going to happen continuing going forward with these FANG stocks. But we're starting to see people react to that by selling them, but they're not going to cash, they're not going to gold or bonds, they're not going into defense, they're simply moving that money into the exchange-traded funds. And last week saw really what I would consider a manic pile of money going into them. And then the other source of buying for the stock market this year, of course, has been the stock buybacks, which are going up at an accelerated rate, even faster than they went up last year. The rate so far is 1.4 billion, up 58% from the year before. And this, frankly, has surprised me, because going into last year, we also saw the bond market take a tumble with the stock market, but it's sharply rebounded up until now, at least. So that's what's helped fuel the buybacks. So that's what's going on. But I think it's going to be very difficult for people to beat the market by basically trying to chase the performance of these exchange-traded funds so far this year.
Also, with the stock buybacks, does that show that companies have run out of ideas on how to expand their business and improve productivity?
Well, that's really what's going on. And in fact, the past 2 years show that to be the case, because the the revenue growth, and sales growth, for corporate America is very sluggish. It's barely going up, in fact. And there actually a couple months last year in which investment spending by companies collapsed. It was even negative. But earnings are up, right? And that's what you hear the headlines say, earnings are up, earnings are up. The reason why is because the companies buy the stock back, take it off the market, and because earnings are generally spoken of as earnings per share, since there's fewer shares, that makes the earnings go up, even if the earnings aren't going up, by the bottom line. So that's what's happening. It's what's been happening, but it's even more pronounced now than ever before. Now, the problem is this is not going to be a permanent condition. At some point, the buybacks will stop when the stock market, tips back down again, or there's a real sign of an economic slowdown. They can virtually stop overnight. That's what's happened in past cycles, and I expect we'll see that happen again before this year is over. But so far this year, of course, we've seen a rebound in the stock market averages. The S&P fell 20% from September till December, but it's now rebounded. It's gone back above its 200-day moving average. However, in bear markets or transition phases at the end of a bull market, typically what you see is a big drop like we saw last year, and then a rebound that happens very fast within just the pace of a few weeks, which is what we've seen so far, and then it completely stops, and you see the stock market typically drift and do nothing for several weeks and then roll over. So whether we're still in a bull market, which is what most people say, or we're in a bear market or transitioning into one, which is what I believe, really doesn't matter for the moment, because what is happening is the market momentum that began in January has basically stalled out, and now we're drifting above the moving averages, above the 150 and 200-day moving average on the S&P, the Dow, and the NASDAQ. Now, the bulls can point to this and say, well, this is a pause, and, we'll break out again, attack the highs, and go up from there. In a sense, that's what happened last year. The market fell 10% in February, went sideways, and then went up to a new high in September. Of course, that new high was a trap. We reversed, but regardless, we consolidated and made a new high. So the expectation among the bulls is that's what we're headed for. We're in a simple consolidation. Will lead to another big rally. However, I think it's probably going to roll over, in which case, we'll see, the market, form some sort of bottom here, go sideways, then maybe by the end of April or in May, begin to decline. Now, what makes me think, one of the reasons I think that's very likely is that the leadership of the rally has been defensive sectors. In fact, gold, and the mining stocks up until last week was among the top 5 performing sectors in the entire stock market. It probably still is up there, but it's, of course, pulled back since Friday. But the number one sector right now is REITs, real estate investment trusts, and you got to go back to the 2000s to see when they were the leading sector, and they led during the summer of 2000 for, I think, the 2002. The reason why is because we were in a horrible recession, a bear market in the stock market caused the Fed to lower rates to zero, and people bought REITs to get a dividend. And apparently they're doing the same thing again. And also utility stocks are at the top of the list for the same reason. So there's an interesting similarity in the structure of leadership in the market when it comes to the sectors to now and the year 2000. And interesting enough, gold also, of course, did well during that bear market. So I see some similarities in those regards to now in some of what was happening then. Of course, in 2008, though, these REITs crashed because of the real estate bust.
We'll have more with Mike Swanson right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Mike Swanson. Mike, what do you expect to happen with gold over the short term?
Well, if you look at gold, last year, of course, it did spectacular from October till just the other week, and it hit a low right around 1170 in August, and it's been going up ever since then. And now we finally had a pullback in the price of gold. And this is really the first pullback it's had since November, when gold went from around 1250 down to 1200. Now we've hit basically the 1350 to 1370 resistance zone, and we're pulling back down to 1280 as we're speaking. Now, if you look at a gold chart, going back, 20-year gold chart, you can see that this 1350 to 1370 level has been long-term resistance now for the past 4 or 5 years. So I don't think this pullback is shocking at all, and my expectation is that we'll still see gold break through that 1350 level in the coming months, but this looks to be a consolidation time. And to prepare the way to do that, we're seeing the mining stocks actually do okay considering the drop in gold that has occurred. Now, we should see gold either form a base here, basically for the rest of the month, and then start to go up again, probably by the end of the month, maybe after the March 20th Fed meeting. Or it's going to, bounce and go back down to, let's say, the 1250 area where its 200-day moving average is, which isn't too much more of a decline from here. It's only another $30. I'm kind of skeptical it's going to do that. But regardless, we're in a pause period, and it's really going to take probably 4 weeks or so to see this really start to play out more, where we can draw, a potential breakout point on the chart. But I don't think that means people should get out. I own mining stocks. I own gold myself. And it's tough, yes, to be 100% invested in something when it's pulling back. It's very difficult to buy and hold triple ETFs. Really probably impossible. Because when gold goes sideways, when the mining stocks go sideways, those ETFs simply decay in value and lose value. So they become toxic situations for people who hold on to them. And I don't think anyone should be involved in them because of that. Buy the mining stocks, buy gold. But it's impossible to be 100% invested in something, and see it pull back as much as gold can pull back or the mining stocks. And really, it's pretty much possible to remain 100% invested in the U.S. stock market for the rest of your life and expect to be able to hold through a 30 or 40% bear market without getting shaken out. So the solution to this dilemma is not to be 100% with all your money invested in anything. And with gold, I don't think you should be either. Put in 10%, 14%, 20%, whatever someone can hold without getting shaken out. And really, if anyone does that, they should be very happy, I believe, in the next 3 to 5 years, with a nice return on that money. And the right mining stocks will really, go up quite substantially. The junior mining market has many small cap and exploration and even development companies that have market caps of 5 million to 3 million even. And when this thing goes into bull market, you'll see almost all of them have market caps of 25 to 30 million, even ones that don't have properties viable for production, really. So I think this is still a great time to invest and pick your spots and not get too alarmed by a pause or a pullback. And even when we go through that 1350 level, ultimately, there's going to be pullbacks after that too. It's just the way markets work. So that's what, I'm sure the bull stock market people would have said too, back in January. But the difference between gold and the U.S. stock market is gold is still above its turn-day moving average. And it broke through it, back in December, whereas the U.S. stock market, has been above its turn-day moving averages, since 2009 without going below it for more than 3 weeks at a time. And then, last fall, it went below it, for weeks and weeks and weeks. To me, that's a sign that you're transitioning into a bear market. We're going back up like we saw, in 2008. The stock market fell pretty nasty, from the summer 2007 to January 2008 and had a fantastic rebound that summer. In 2000, there was a April hit and then a big rebound that summer. And then it rolled over. So I think we're just having that rebound type of rally situation. And, as I said, the difference is the U.S. stock market went below the moving averages and has just rallied back above it, whereas gold rallied through it and is still above it. So to me, that makes gold a much better, proposition, to buy and hold, going forward. And there are subtle psychological changing starting with the masses of Americans. They're not interested in gold yet. However, last year, they were all obsessed with FANG, Apple, Facebook, Amazon, Netflix, Google, Nvidia, these fad stocks. That obsession is beginning to end. They're starting to get out of that and think, I got to do something different. So they're piling into SPY, QQQ, the Dow Diamonds. But if they start to tumble too, which I do believe will happen before this year's over, then they'll say, well, what do I do now? And I think they're going to start to buy gold, especially once it goes through 1350. Some of them are buying marijuana stocks. They chase price action. Whatever is hot, they buy at the top. Then when it goes down, they get out, and then they see what's going up the most and grab onto that. It's not gold at the moment, it's marijuana stocks. So some are buying that. But in the future, there will be a time when the stock market's going down and these people give up on their SPY, their QQQ, their diamonds, and they'll be buying GLD, they'll be buying GDX, and some of them will be buying junior mining stocks because they're going to really want to make some money.
We'll have more with Mike Swanson right after the break.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, could stocks for marijuana be influenced by the fact that several of the Democratic candidates for president believe that marijuana should be legalized?
Well, right now, it's hard to say because that won't really matter, I don't think, until next year when they really get the primary season going. Where the marijuana stocks, actually, we talked about them the last time we did an interview, and at that time they were going sideways. They were consolidating. They had a nice run in January, but they fell the stock market also last fall. However, I think they're really, at the moment, the best speculative sector that has the most upside potential this month. I don't know what they're going to do over the course of the rest of the year, but despite all the negative things I said about the U.S. stock market, I don't think we're on the verge of an imminent decline in averages. I think we're going to go sideways and not much is really going to happen. And in that environment, these marijuana stocks can break out of these consolidation patterns that they seem to be in right now, and attack their highs or even go through them. So, for example, Canopy Growth, it's trading in a range of $50 as resistance, $42.50 as support. And that range is narrowing, and it's in a position where it could break out, at any day and make a run. And I don't know, that could coincide with some politician somewhere in the United States saying some positive things about marijuana. Obviously there's states that you can now buy marijuana in these bizarre capsules and liquid things these kids are playing with. But it's out there. It's just nothing. It's just, when I was in high school, I smoked joints, not very often, but a couple times. So liquid stuff is just weird to me. I'm just too old fashioned for that. I'll smoke a cigar every once in a while, but that's the market. That's what young people like. And it can definitely, so the interesting thing is in a way, they're the ones buying stocks. I saw the CEO of Ameritrade on CNBC talking about this Ameritrade index report earlier this week, and he said, wow, the overall, in aggregate, account holders have been net sellers of individual stocks this year. The millennials, the younger people, are net buyers. So I think they're the ones buying these marijuana, or they're a big part of the reason these marijuana stocks are doing good. The Robinhood company, they cater to millennials and people with small accounts, and marijuana stocks are just all over the top 100 list, and it displaced some of the FANG stocks. So this is the area now where the hot money's going, and any positive news can encourage these people to buy, but I really have no inside track on anything, that's going to develop anytime soon when it comes to individual politicians making statements. But I definitely do think they do make it clear, at least the Democrats, that they are friends of the marijuana sector, at least in spirit.
Mike, thank you so much for being on the show.
Oh, great talking with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at talkdigitalnetwork.com. HowStreet.com Radio is a production of How Street Media Incorporated.